Good afternoon. Thank you for joining us for today's webinar, Opportunity Zones, Minimize Capital Gains Tax with this Powerful Tool. I'm Bob Sharon, the Partner and Tax Practice Leader. I've been working with high net worth individuals, family groups, and a range of businesses spanning multiple industries for over 35 years. My primary focus is enabling Friedman's tax department to efficiently assist clientele with tax planning and compliance needs to sustain and increase their assets. Speaking today is Stephen Bocaius, partner at Friedman with more than 20 years of experience. He leads the firm's qualified Opportunity Zone consulting practice and specializes in advising prominent real estate organizations involved in a wide range of properties. Stephen also brings extensive experience to the financial arena. Joining Stephen today is Michael J. Greenwald, partner and corporate and business tax practice leader. Michael has more than 35 years of experience in public accounting. He has served clients in a variety of industries, including financial services, technology and media, manufacturing, wholesale distribution, private equity, real estate, construction, and professional services. Michael is the chair of the Partnership Taxation Technical Resource Panel of the American Institute Certified Public Accountants. Friedman is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry in all regions where we operate. Friedman is dedicated to helping clients maximize their tax position and uncover opportunities in light of sweeping tax changes resulting from the Tax Cuts and Jobs Act. I apologize. Apparently you can get the flu even though you've had a flu shot. Please bear with me. In response to growing questions surrounding a new investment strategy created under the Tax Cuts and Jobs Act, Friedman recently formed a qualified Opportunity Zone consulting practice. With Opportunity Zones currently spanning 12% of the land area of the nation, there is tremendous opportunity for individuals and businesses to reap significant tax advantages. The question is, how? Today's presenters will provide an overview of how Opportunity Zones are defined, the two-pronged tax benefits of investing in a qualified Opportunity Zone fund, meeting the fund asset test, and the optimal structure of qualified opportunity fund. We will also address vital questions that remain unanswered at this time and key takeaways. We are pleased to bring you programs such as today's webinar, and will continue to share insights as new guidance is released to help you navigate the complex and evolving tax landscape. On February 27th, our state and local tax experts will be presenting a webinar providing guidance on navigating complex domicile and statutory residency rules in light of increased state income tax audits and how to avoid harsh penalties. Now, at the conclusion of today's webinar, we will attend to questions from our listeners. You can submit your questions and communicate with us throughout the course of the webinar using the chat box featured on the lower portion of your screen. We would also be delighted to schedule time to speak with you one-on-one to better guide you on your particular situation. And at this time, I'm pleased to turn the presentation over to my colleague, Steve Bocaius, who will kick off the program.
Thank you, Bob. The first question is, what exactly is an Opportunity Zone? An Opportunity Zone is a population census tract that meets the definition of a low-income community. So clearly, these are low-income communities in some economic distress. The designations were chosen by the states and certified by the U.S. Treasury in the spring of 2018. There are over 8,700 Opportunity Zones in all 50 states, Washington, D.C., and the U.S. territories. And as Bob alluded to, Opportunity Zones comprise approximately 12% of the entire United States, which, when you think about it, is a large landmass. These Opportunity Zone designations are redrawn every 10 years, and the first set of Opportunity Zones will be redrawn on December 31st, 2028. The designation through tax incentives are intended to facilitate the movement of capital into these low-income areas to develop property and create and expand businesses, creating jobs. The concept of qualified opportunity zones is new. It was created by the Tax Cuts and Jobs Act that was passed in December of 2017. That law created sections 1400Z1 and 1400Z-2. So the main incentive are the tax incentives. So what are the tax incentives? The tax benefits are two-pronged. First, there's the temporary deferral of capital gain recognition through December 31st, 2026. And secondly, the permanent exclusion of post-acquisition appreciation in the Qualified Opportunity Fund investment if the investment is held for at least 10 years. So what does that mean? In terms of the first benefit, deferring capital gains. Anyone who makes a qualified investment into a fund can defer capital gains to the extent cash equal to the amount of the gain is invested in the fund. So if taxpayer A sells stock at a gain of $1 million and invests $1 million of cash into the fund, that gain is deferred and, all else being equal, does not become taxable until 2026. So if that sale occurs in 2019, that gain is deferred for 7 years. In addition, there's a permanent exclusion of a portion of that deferred gain if the investment in the fund is held for a certain period of time. There's a 180-day rule for deferring capital gains. From the point that a taxpayer realizes a capital gain, the taxpayer has 180 days to invest a corresponding amount of cash up to the amount of the deferred gain into the fund. The taxpayer is able to defer the invested gain until the earlier of the date the taxpayer sells or exchanges his investment in the fund, or December 31st, 2026, whichever comes first. So one thing that's important to keep in mind is that the initial gains invested in the fund, the gain is not totally excluded, it's just deferred until December 31st, 2026. If a taxpayer invests in a qualified opportunity fund with deferred capital gains and sells their investment in that fund, the taxpayer has the option to roll that gain into another qualified opportunity fund and defer the gain again, as long as that's done within 180 days. One caveat to keep in mind is that in order to defer the gain into a second qualified opportunity fund, there has to be a complete disposition of the taxpayer's interest in the first qualified opportunity fund. So if a taxpayer invests in qualified opportunity fund A and decides that the investment isn't doing well, would rather go into qualified opportunity fund B, in order to roll over the gain and not trip it into taxable income, his entire investment in qualified opportunity fund A has to be disposed of. In regards to the initial investment of deferred gains, if the investment in the fund is held for at least 5 years, 10% of that deferred gain is eliminated from future taxation. If the investment is held for at least 7 years, 15% of the deferred gain escapes taxation. So to give an example, if a taxpayer sells stock at a gain of $1 million and invests $1 million of cash in the qualified opportunity fund and holds it for 7 years, $150,000 of that gain is permanently excluded from taxation. On December 31st, 2026, $850,000 of capital gain would be realized. The second major benefit is that any appreciation on the investment of the fund escapes taxation permanently as long as the investment in the fund is held for at least 10 years. So going back to our example, taxpayer invests $1 million of capital gains into the fund, holds it for 10 plus years. On December 31st, 2026, the taxpayer realizes a capital gain of $850,000. Notice that $150,000 of the initial deferred gain is gone. If, say, 12 years down the line, the taxpayer sells that investment for $1.3 million, there's a $300,000 gain on the sale of the fund. That gain is permanently excluded from taxation. So the benefits are two-pronged: the deferral of the invested capital gain and the potential elimination of 15% of it, and the complete escape from taxation of the appreciation in the qualified opportunity fund as long as it's held for 10 years. One common question is, what if somebody invests more than the gain realized? That is okay, but there are the tax benefits only apply to the extent that deferred gains are invested. Any cash on top of that doesn't receive any additional tax benefits. So if a taxpayer invests both deferred gains and other funds, the investment is treated as two separate investments. The investment made with deferred capital gains has the deferral and has the escape of taxation on any appreciation after 10 years. The investment made with non-gains is deemed to be just an ordinary investment in a corporation or a partnership with no special tax benefits.
Steve, what about borrowed money that's invested? Does that get the same gain deferral after the 10 years, or gain elimination after the 10 years?
Based on the guidance that we've seen so far, we've seen nothing that would say that if the fund uses borrowed money or leverages, that would impact the exclusion of the gain after 10 years. But again, that is considered an open issue. So let's have an example of a taxpayer that sells stock for $5 million, and of which $3 million is a capital gain. And the taxpayer decides to invest the entire $5 million, not just the deferred gain, into the fund. So what exactly happens? This is deemed to be two investments, one for $3 million of deferred gains, and one for $2 million of non-deferred gains. So the $3 million, it's realized in 2019, it's not subject to taxation. If it's held until 2026, 15% or $450,000 of that $3 million gain escapes taxation permanently, and only $2,550,000 of that gain becomes taxable in 2026. Let's assume that 12, 13 years down the line, the taxpayer sells his investment in the fund. And let's assume the $3 million piece of the investment is sold for $7 million. The entire $4 million of appreciation is eliminated. Now, in terms of the $2 million investment, which was made with non-deferred capital gains, let's assume that piece of the investment is sold, for $5 million at a $3 million gain. Well, that gain is taxable because deferred capital gains were not used to make that investment. So all the benefits in investing in qualified opportunity funds only apply to the extent that the investment is made with capital gains, and deferred capital gains at that. If the election isn't made to defer the capital gain, there are no benefits. So what entities are eligible to be qualified opportunity funds? Can it be any entity? The qualified opportunity fund has to be a corporation or a partnership for federal tax purposes, created domestically in one of the 50 states, DC, or U.S. possession. There is a caveat: if the fund is formed in the U.S. possession, all of its investments in qualified opportunity zone property have to be made within that U.S. possession. So I couldn't form a fund, say in Puerto Rico, and use that fund to invest in the United States. I would have to form the fund in the United States in order to do that.
Steve, can a single member LLC be a qualified opportunity zone fund?
No, under the rule, the entity has to be regarded, and a single member LLC would have no regarded status. So a partnership would need to have at least two partners. An LLC would need to have at least 2 members. Only capital gains can be deferred, and that's an important point to make. Based on the wording of the statute only says gains can be deferred. And some commentators believe even ordinary income could be deferred. The proposed regulations, which came out in October, made it clear that only capital gains can be deferred. And in order to defer the capital gain, it has to be treated as a capital gain on the taxpayer's tax return for federal purposes. So what exactly does that mean? If a taxpayer sells real estate and has any 1245 ordinary recapture, that gain can't be deferred. If a taxpayer sells real estate at a 1231 gain, a 1231 gain can either be long-term capital gain or ordinary, depending on specific circumstances. To the extent that 1231 gain is capital, it can be deferred. To the extent that 1231 gain becomes ordinary, that cannot be deferred. So the takeaway point is that the gain has to be treated as a capital gain on the ultimate taxpayer's federal return. What's the last day to invest in an opportunity fund in order to get these benefits? The gain can't be realized any later than December 31st, 2026. And the investment has to occur 180 days after that, which is on or around June 30th, 2027. So after 2026, the benefits go away for any future investments. The gain can't arise from a sale to a related person. The IRS doesn't want somebody selling property to themselves to defer the gain and get these benefits. And related entities deemed to be 20% common ownership. If I've had property for the past 10 years and it's in a qualified opportunity fund, I can't sell it to another partnership that's related in order to get these benefits. So what taxpayers are eligible to defer these gains through investing into opportunity funds and getting the benefits? Individuals, C corporations, including RICs, which are mutual funds and REITs, partnerships, S corporations, trusts, and estates. So effectively, almost any type of taxpayer can take advantage of this. One thing that's key, even flow-through entities, even partnerships, even S corporations, which don't pay tax for the most part at their own level, can make this election. So let's talk about flow-through entities. Either the flow-through entity, which could be a partnership, an S corporation, a trust, or an estate, or its partners, shareholders, or beneficiaries can elect to defer the gain and invest in an opportunity zone fund. If the flow-through entity elects to defer the gain, the respective capital gain isn't reported on the partner's K1, so the partner has no gain to defer. If the flow-through entity doesn't elect to defer the gain, well, the capital gain comes through on the K1, and the partner has the ability to defer up to the entire amount of gain on the K1. So how does this play into the 180-day rule? For partners, shareholders, and beneficiaries, the 180-day rule begins on the last day of the flow-through entity's taxable year. So if I'm investing in a partnership and that partnership has a December 31st calendar year end, and I get a K1 showing $100,000 of capital gain, I have 180 days from December 31st to make that investment. Alternatively, the partner, the shareholder, or the beneficiary can elect to treat its own 180-day period as being the same as a partnership's. So what does that mean? If a partnership sells a capital asset on March 1st, 2019, the partner can elect for its own 180-day period to start on March 1st. Why would the partner want to do that? Because the investment opportunity may be now. The investment opportunity may not be after December 31st.
Steve, there's also a number of comments that came into the IRS on the proposed regulations, wondering if the start could actually be on the start of the 180-day period for a partner could be on the extended due date of the return. Concern being that the partnership might report capital gains that the partners were unaware of, and by the time they got the K1 from the partnership, they would have missed the deadline for reinvesting in an opportunity zone.
That definitely makes sense, because if a partnership extends, its extended due date is September 15th. If I don't receive my K1 until September 14th and I had no idea that there was a gain, and that K1 has a huge amount of capital gains on it, well, I've already passed the 180-day mark, which would have been around June 30th of that year. So it does make sense that that 180-day period would be extended in those circumstances. So we have a partnership gain deferral example. Let's assume 4 individuals own partnership A equally, and partnership A realizes a capital gain for $10,000, but elects not to defer it. Assume each of these 4 partners receives a gain allocation of $2,500. 2 of the partners want to defer it, 2 of them don't. Let's assume let's assume that the sale occurs in 2019, and partner A finds an investment opportunity which isn't available until 2020. Under the general rule, partner 1 could say, well, my 180-day period begins on December 31st, 2019, so I have 6 months from that until June of 2020 to make my investment. That works. Let's assume partner B says, well, I have a $2,500 capital gain. I need to defer that now because that opportunity isn't going to be around a year from now. Under the elective rule, the investment could be within the 180-day period by adopting or starting the 180-day test on the day that the partnership realizes the gain, which in this case is February 1st. So the partner would have 6 months roughly from that, or until August 1st, 2019, to deploy those funds. Now, this requires coordination between the partner and the partnership, because without communication, the partner isn't going to know what amount of gains have been realized. So logistically, how do we elect to defer capital gains? It's done very simply. It's on Form 8949, which is an attachment to Schedule D, and which is attached to the taxpayer's tax return. Taxpayer shows the transaction, enters a code to defer the gain, saying it's going into an opportunity fund, and the gain is deferred. Tax attributes of the deferred capital gain. Well, let's assume that I incur $1 million short-term capital gain in 2019, and I defer that until 2026, at which point 85% of it becomes taxable. Does that short-term capital gain, because I waited 7 years to get up into taxable income, become a long-term capital gain? The answer is no. The characteristics of the deferred gain stay the same. So if a short-term capital gain is deferred, that gain stays short-term 7 years into the future when it's realized. Long-term capital gains stay long-term. Unrecaptured 1250 gains retain that character. 1231 gains retain that character. So what happens if I invest in an opportunity zone fund at different points in time? Let's assume I start off by investing $500,000 in short-term capital gains, and then I make another investment for $1 million of long-term capital gains, and then I decide I really don't like this fund, so I sell $750,000. Which gain is released? The long-term capital gain or the short-term capital gain? Two investments that were made at different points in time? Well, the proposed regs call for a FIFO method, first in, first out. So first I invested $500,000 of short-term gains. Then I invested $1 million of long-term gains. So my first $500,000 of proceeds, my first $500,000 of gain is going to be tied to that $500,000 short-term investment. Anything beyond that will go to the second tranche, which is a long-term capital gain investment. So as I discussed in the beginning, these qualified opportunity zone designations are redrawn every 10 years. So the first batch are going to be redrawn on December 31st, 2028. So what happens if I sell property in the fund when that area is no longer considered a qualified opportunity zone? The proposed regulations make it clear that even if the qualified opportunity zone investment was sold in 10+ years and the designation is expired, the gain is still permanently excluded from taxation as long as all the other requirements are met. I mean, you would have had to hold it for 10 years and everything else. Another point to keep in mind is that, yes, the gain on the sale of a qualified opportunity fund held for more than 10 years is permanently excluded, but under current guidance in the proposed regs, the interest in the qualified opportunity fund has to be sold by December 31st, 2047. If an interest in a qualified opportunity zone fund is sold on January 1st, 2048, the gain is taxable. So the question is, how was that December 31st, 2047 date arrived at? Well, the last day to realize a gain to invest is December 31st, 2026. You would then have 180 days from that point on around June 30th, 2027 to invest the gain. You'd have to hold that gain for another 10 years, that investment for another 10 years to be able to exclude the gain, which would bring you to June 30th, 2037. The regs give you another 10 years to hold the investment until you have to sell it on December 31st, 2047, which is 20 and a half years after the initial investment. Some commentators believe that this is going to be changed because otherwise you may have a bunch of funds in 2047 trying to dump property, depressing the price. From an economic perspective, it doesn't really make sense.
I think a lot of things are going to be changed besides this between now and 2047, but
I think you're right.
Let's wait and see.
I think you're definitely right. So how does a partnership or a corp become a qualified opportunity fund? The entity self-certifies by filing a form with its tax return in which it wants to make the election. It's Form 8996, which I believe as of now is still currently in draft form. I don't think it's been finalized yet. Interestingly enough, an entity doesn't have to go through any specific approval process or any vetting process. It basically attaches the form to its tax return, says it's electing to be a qualified opportunity fund, and it's a fund. By the end of the first year, there's a requirement that the organizing documents have to include a statement that the purpose of the entity is to invest in qualified opportunity zone property and to include a description of the business or businesses in the opportunity zone that the fund is planning to invest in. The Qualified Opportunity Zone Fund, when it makes its initial election, decides the year that it's to become effective and the month during that year. The month that it makes the election is very important. You know, let's assume that a fund elects to be a Qualified Opportunity Fund on July of 2019, and Investor A jumps the gun, realizes a capital gain in February 2019, and invested in the fund in March of 2019. Well, the fund wasn't technically a Qualified Opportunity Fund until July 1st, so that gain is not deferred and there are no benefits. So it's very important when somebody invests in a fund to ensure that it has made the election and the month during its initial year that that election becomes effective. So once an entity is a Qualified Opportunity Fund, there's a 90% asset test that needs to be met. And this testing occurs every 6 months. So 90% of the Qualified Opportunity Fund's assets have to be Qualified Opportunity Zone property. Qualified Opportunity Zone property includes Qualified Opportunity Zone stock, which is an investment in a subsidiary corporation, a Qualified Opportunity Zone partnership, or Qualified Opportunity Zone business property. And I'll go through what each of those 3 types of property is. Again, this 90% test occurs every 6 months, and the results are averaged during a taxable year, and at least 90% of the assets have to be Qualified Opportunity Zone property. Interestingly enough, if a Qualified Opportunity Fund has everything done through subsidiaries, through either a Qualified Opportunity Zone partnership or Qualified Opportunity Zone corporation, 100% of its assets are deemed to be Qualified Opportunity Zone property, and its percentage would be 100%. Wouldn't even have to worry about being beneath that 90%. So a lot of commentators are suggesting that the fund create a subsidiary partnership or a subsidiary corp to hold the business.
Steve, while you're waiting to make the investment during the test period, can you invest the idle funds in money market accounts?
There's a working capital safe harbor. It's a little fuzzy when you get the initial investment. A lot of people believe that during that first 6 months, you have to make the initial investment. Under the working capital safe harbor, cash is then considered to be a good asset as long as there's a written plan that identifies the cash as being held for a project, and there's a written schedule to deploy that cash within 31 months that the business substantially complies with. So I think once the fund is set up and the initial cash goes in, the cash has to be, a purchase has to be made within 6 months, but then there's a 31-month period to sit on additional cash to improve the property or to acquire more property. Now, it's unclear whether the safe harbor applies only to Qualified Opportunity Zone businesses, which are subsidiary partnerships or corps, or also to Qualified Opportunity Zone funds. People believe that it would apply to both, but right now a lot of commentators are suggesting doing everything to a Qualified Opportunity Zone subsidiary business.
Yeah. And the way the reg is written, it implies that that safe harbor is only available for Qualified Opportunity Zone businesses. So to be safe, if that's what you're planning on doing, structuring the deal right now would make sense to use a fund owning a business.
So the first test, whether you're doing this through an Opportunity Zone business or directly, is what is Qualified Opportunity Zone business property? It's property acquired by purchase after December 31st, 2017. That trips a lot of people up because they already have, say, a building in the fund, but they've had it for prior to January 1st, 2018. The property has to be acquired by purchase after December 31st, 2017. Either the original use of the property in the zone commences with the fund or the subsidiary business, or the Qualified Opportunity Fund or business substantially improves the property, and the property essentially has to be used within the zone. So let's assume that I have to meet the substantial improvement test. It means that within 30 months, I have to double my investment in the property. So if I buy a building in the fund, say for $1 million, that building has existed in the fund prior to my acquisition, which means I have to substantially improve it. So if a fund pays $1 million for a building, it divides up the cost between land and building. Let's assume $800,000 is allocated to the building. Within 30 months, the fund has to invest another $800,000 into the building, doubling its investment in order for the building to be a qualified asset. So the question may be, why would somebody do that? Or why is that requirement there? Because if the property is already in the zone, there's no benefit from selling it to A to B. The property is already in the zone. The rule is that you have to improve it. You have to spend money in the zone. If property is brought into the zone, there is no substantial improvement requirement. So just to clarify, again, property has to be acquired by purchase after December 31st, 2017. The original use of the property has to begin with the fund or the business. If the property has already been in the zone, the property has to be substantially improved, which means the investment in the property has to be doubled within 30 months. So a lot of people think the property acquired has to be new. It doesn't have to be new. It's just that the original use of the property in the zone has to originate with the fund or its subsidiary business. Otherwise, if the property was already sitting in the zone, it has to be substantially improved by doubling the investment.
So in other words, if I take my opportunity zone and buy a pizza shop, and it's got tangible properties that I've acquired, I've got to now double that investment. Whereas if I just rent a store and go buy new pizza ovens or even used pizza ovens and bring them into the zone, and their first use in the zone is with me, then I don't have any substantial improvement requirements.
That's right. So effectively, the rules are designed to incentivize bringing either new property into the zone or improving property that was already there. Selling property from A to B within the zone, in the view of the drafters, doesn't do any good. So what is a qualified opportunity zone business? It has to meet certain requirements. It's a partnership or a corporation that's acquired after December 31st, 2017. Just remember, with qualified opportunity zones, you can't do anything prior to January 1st, 2018. You can't, otherwise it doesn't qualify. So you acquire, it's a qualified opportunity zone business, an interest in a partnership or a corp, acquired for cash after December 31st, 2017, at original issue. You have to be the original owner of that interest. So what requirements do these partnerships and subsidiary corps have to meet? 70% of the tangible property owned or leased has to be qualified opportunity zone business property. We've already gone through what that means. Now keep in mind, this is a benefit of using a subsidiary business. If the fund is invested directly in the business, 90% of the assets have to be in the zone. If a subsidiary business is running everything, only 70% of the assets have to be in the zone. So there's a benefit to doing this with an operating business that's being run in the zone. Now, real estate either is in the zone or it's not in the zone. It's not as key for real estate, but if I'm running a business and I have to have some operations outside the zone, I'm definitely better off doing this with a subsidiary partnership or corp. At least 50% of the entity's gross receipts, gross income, has to be derived from the active conduct of the business in the zone. It still remains to be seen what exactly that means.
So, but for example, Steve, my pizza shop could deliver to pizzas to people in the zone and also deliver to people outside the zone. But I've got to make sure that at least half of my customers are in the zone.
Or that the work, at least half the work is done in the zone, even if you ship it out. But again, that last point I made is speculation. It's not clear. I think if the point is to promote employment in the zone, as long as the work's done in the zone, it shouldn't really matter if property is being shipped outside the zone. But that remains to be seen. A substantial portion of any intangible property has to be in the zone. Less than 5% of the non-qualified financial property can be, in other words, a business can't have more than 5% of non-qualified financial assets, which is cash, unless you meet that working capital exception. And there's certain businesses that are prohibited. Qualified opportunity fund or business can't run a commercial golf course, a country club, a massage parlor, a hot tub facility, a racetrack, a gambling establishment, or a liquor store. All other types of businesses are fair game.
So Steve, taking Michael's example of the pizza joint, let's say that it doesn't do very well, and after 2 or 3 years, you want to convert it to a liquor store. Is that a problem?
It is, because you'd no longer have a qualified asset, and you'd probably blow your qualification as an opportunity fund. At the very least, there'd be penalties you'd have to pay.
But can I turn it into a bar?
That's a good question. I guess, there's no prohibition against restaurants. So as long as you serve food too, that may be okay. If you're just a bar, that could be a problem.
Not a liquor store.
That's true.
It's a liquor establishment.
That's true. Hopefully there'll be clarification on that.
Let's just hope we do well with our pizza.
So there are a lot of unanswered questions. One of the code sections authorizes the IRS to provide guidance on what happens if a qualified opportunity fund sells a business, sells an asset, and then is sitting on cash. Well, it may not find replacement property within 6 months, and theoretically could fail the asset test. There's currently no guidance on what happens if you're in between investments. And the IRS is slated to issue regulations addressing these issues. Can pre-existing on-the-shelf entities elect to be a qualified opportunity fund or a subsidiary entity operating as a qualified opportunity zone business? The answer is yes, unless all the requirements that as long as all the requirements that we talked about are satisfied. The tax benefits of investing in a fund, the deferral of capital gains for 7 years, the elimination of 15% of it, the elimination of the gain on the appreciation, they're all very attractive. But as with anything, you don't want the tax tail to wag the dog. This is also a business decision, and there's no point in going after tax benefits with a bad business decision that loses money. So the business decisions have to be evaluated as well. When the deferred capital gains become taxable in 2026, the money is still tied up in the fund. So investors are going to need cash from another source to pay the tax. So that's something to keep in mind. To achieve the full tax benefits, this is a 10-year commitment. Someone can't go into these funds with the idea of, I'll go in for 2 years, defer my gain and get out. You're really missing a lot of the benefits if you're doing that. And also, someone can't go into an investment with the intent that we'll hold this for 50 years. The investment as of now, under the guidance, has to be sold by December 31st, 2047. Again, some people think that that's going to be extended or eliminated. It's still unclear.
Okay. Thank you, Steve, Michael, for that informative discussion. Now that concludes today's presentation.